Welcome to After Hours Action. I'm Gregg Greenberg from TheStreet. And the big action in extended hours trading is Cisco, of course. The tech giant reported Q1 results that missed on the top line but beat by 2 cents on the bottom. To ease the pain of its sales shortfall, Cisco also announced a $15 billion stock buyback. Shares of the company are down 2% at last check. Now, let's wrap up the market. U.S. stocks started Wednesday lower due to a sell-off in Asian shares, but closed at another record high. The S&P closed up 14 points to 1782, while the Dow finished 70 points higher. That's a record. And the Nasdaq was up 1% to close at 3966. Stocks in Asia fell in reaction to the end of a 4-day meeting that aimed to outline Chinese economic policy for the coming decade. Unfortunately, investors emerged from the get-together with a lack of clarity around financial reform. Back home, Macy's shares surged 9.5% today after the department store reported third-quarter earnings that beat street estimates on the top and bottom lines. And GM was a big mover today, popping 5% after the Treasury Department disclosed a $1.2 billion sale of shares in the automaker. Once the government gets its whole self out, that frees up GM to bring dividends back and buy back shares. Now, U.S. stocks have been on a tremendous run, with the S&P up 25% so far this year. That makes us a world beater, outpacing Europe, Japan, and most emerging markets. But that doesn't mean investors should turn their backs on foreign stocks and go entirely domestic. Earlier today, I talked about the importance of a globally allocated portfolio with Alec of S&P Capital IQ. Alec, U.S. stocks are on a roll hitting new highs, so why should people want to get into foreign markets now?
Well, I think it's important to keep in mind that no one market around the world has always got the hot hand. Right now, it's true the U.S. is doing very well, but we took a look at the efficient frontier, which is sort of an objective, data-based way of looking at what's going to get you the highest possible return in your portfolio, while at the same time minimizing risk. And actually including some international exposure will lower your risk profile of your equity portfolio, but actually boost your return potential. And we found that a 70-30 mix between U.S. stocks and international stocks gets you the highest risk-adjusted performance. And within that, if we break out the international part a little bit, if we actually put 70% in the U.S., 20% in developed international stocks, and 10% in emerging markets, that specific mix actually optimizes performance the most.
So is now a good time to rebalance? So for example, if your U.S. allocation has really overshot itself, it's done very, very well, is now a time to sell some of your U.S. and buy some emerging market shares because they've underperformed?
Absolutely. I mean, whenever you have anything that's really significantly overshooting your target asset allocation, rebalancing makes a lot of sense. So in this case, it would be to pare back the U.S. equities and increase the international exposure. Developed international markets, Europe, Japan, have done very well this year. Emerging markets have lagged, so you'd probably be taking some profits out of U.S. and deploying them into emerging. But we would keep that 70-20-10 breakdown between the three asset classes in mind in terms of an optimal target allocation for your typical moderate risk investor that has a long-term time horizon.
And then let's talk a little bit about Japan. People expected some great things from Japan at the beginning of the year with Prime Minister Abe and a weakening yen. But the yen has not really weakened. It's really stuck below 100. What are your expectations for Japan, especially going into 2014?
Well, I think the problem in Japan, we've seen a huge liquidity-fueled rally. We had the BOJ getting very aggressive with their bond buying. That weakened the yen in the first half of the year, and it boosted earnings and boosted exports, and that drove a huge rally in Japanese stocks in the first half. It's sort of stalled out, and Japan's underperforming here in the second half, and I think the problem is that a lot of the stimulus from the central bank has been factored in, and at this point, people want to see structural reforms in Japan. They want to see labor market reforms, corporate tax reforms. Women do not play a very significant role in the Japanese workforce at all. There's a lot of low-hanging fruit there if they can get some of these structural reforms through. The problem is the results so far have been a little underwhelming from the Abe government, and at the same time, we have a new value-added tax, a sales tax, set to kick in April of next year. And so there are concerns about what impact that's going to have on growth. And so investors really want a bit of an insurance policy in terms of the Japanese growth outlook by seeing some more progress in terms of labor reform and and corporate tax reform. So I think we're kind of waiting to see that come through to get a little bit more upbeat on Japan. We see it doing okay. We see global stocks continuing to rally next year. So we think Japan will participate in that. But right now, without the structural reform momentum, we don't think it's going to return to that really strong pace that we saw in the first half of 2013.
And then finally, do you believe that Europe has made the transition? We've seen Spain bottom out, for example. We've seen better numbers during third quarter earnings season coming out of companies that do business in Europe. Do you think 2014 Europe really takes off after making the turn at the end of 2013?
Well, we have to differentiate between their economies and the stock markets. Their economies are just turning positive here in the fourth quarter after a double-dip recession. We do expect the growth to continue next year and Europe to post about 1% growth in 2014. The stock markets, though, really saw this improvement coming way ahead of time, and Europe's had an excellent year. It's up about 15, 16% in dollar terms this year. We do see Europe appreciating more next year, but keep in mind Europe's not as cheap as it used to be. A lot of the economic improvement has already been telegraphed in the European stock market. So we think stocks continue to rise in Europe, but we're not looking for another 20% type year.
All right, thanks a lot, Alec.
Okay, sure, Greg.
Our thanks again to Alec Young of S&P Capital IQ, and thank you for watching After Hours Action on the Street. From New York, I'm Gregg Greenberg.